OTC exchange traded versus listed derivatives, looking at the technology challenges associated with that transition. Today we have a great group of panelists. I'm going to skip you, as I'll introduce you last but not least, but all the way at the end, we have Rob Catterall with Man Investments. To his left, I believe, yes. We also have Paul Orchard with UBS, or is that, sorry, Paul. And finally, Jamie Gavin with Morgan Stanley. And then to my right, who got me all confused here, Will Rhode is also with TABB Group as an analyst. Today's panel, we're going to try and keep it lively. It's getting towards the end of the day. We have a session right after this we're going to go right into. So I want to get you guys involved. I want to get you engaged. I want you to ask questions, disagree, throw stuff at these guys. I'm going to let them run the panel. They're going to start fighting if you don't throw things at them. So we're going to get really going. And to start the brawl here, Will, can you tell us what's going on from a big picture kind of regulatory perspective, what you see as the big drivers, the big things that are going on, and then we'll kind of just get into the meat of the issues.
Sure. Thanks, Andy. So I don't know how many of you guys were sat in on the last presentation by Kay Swinburne, but you know, it's kind of encouraging just to understand, at least from what she's telling us, that there is a coordinated effort towards regulation in Europe when it comes to derivatives. There's obviously a lot of crossover between the MiFID review, which is talking about trading of derivatives in OTFs, or organized trading facilities. Meanwhile, there's the Central Clearing Counterparty Initiative, which is basically mandated under EMIR. Meanwhile, there's also Basel III, which is going to, significantly impact the cost of trading over the counter. Then there's the coordination with Dodd-Frank to make sure there's no regulatory arbitrage between the US and Europe. There's different publishing dates. There's wording debates. When I summarize it and think about it all like that, I can't imagine that it's coordinated. It just seems too complex for it to even get close to being singularly coordinated. And also, just to throw into the mix, by the way, lobbying by vested interests who are essentially competing for these very attractive opportunities. Seemingly, in the wake of the G20 mandate to see derivatives move into a central clearing counterparty model, exchanges were almost delivered, a beautiful opportunity, a beautiful thing, a collateral market opportunity, which we sized it at around $2 trillion. Now there's a wording debate over EMIR to say that it's not just going to cover over-the-counter derivatives, it's also going to cover listed derivatives. So essentially you're seeing brokers now recompete and say, well, actually we could continue to trade as we always have done for these instruments on organized trading facilities. So I think this is the very complex regulatory landscape that we're looking at. In terms of how it all pans out, I think it's open season in terms of the ability to make your voices heard in Brussels, and to make sure that the business interests are not taken away from you by parties that essentially out-lobby you. But it interests me what the dynamic is going to be, and I'm interested to hear from these guys between the difference between an SEF or SEF and an OTF. Is it going to be a case of I say tomato, you say tomato? Or are there going to be key differences that we're going to exploit? So those are some of the key things I'm seeing, and yeah, I'd like to hear from these guys what they think is going to happen in terms of SEFs and OTFs. So I'll hand over.
Rob, I'll throw it down to you. What's the best market structure for trading a swap? Is it a central limit order book? Is it an RFQ model? Should it see the light of day? Should it be a fully transparent pre-trade price quotes, post-trade transparency? What best suits how you trade, how your firm trades, and how will it best apply to you?
Particularly looking at IRS, I certainly don't see it on an RFQ basis. I think across a whole range of markets, RFQ just puts down too much information. I think so. On some sort of streaming would have to be your best option. Sorry, so
you may have to get a little close.
Sorry. Some sort of streaming would be the ideal basis, but obviously, unlike a bond or a FX style, where you've just got one contract, one period, That's very difficult for IRS. So I think the concept, and we were discussing before about what you decide is going to be cleared, who puts down the rules for what can be cleared, makes it very difficult. What's a generic trade? Is it a 10-year? Is it a 10-year out of 1 day forward? So I really, in my eyes, it's not clear yet. We're following the situation very closely. We're very well prepared, but I don't think it's clear.
Paul, what are you seeing from your seat? What are your clients saying? What are you thinking about? How's it going to work? We were just talking about, the multitude of allocation processes that'll occur.
I guess the background from the listed market is that you have seen various pockets of liquidity trade in very different ways. So today in the futures and options world, you see index futures trade from HVDMA fully electronic to a phone around options market that ends up getting centrally cleared post-trade. And I think that range of liquidity models is going to be essential to maintain as we migrate these, what are going to be called standardized swaps, as defined by the regulator in different timing, in different places. The phasing approach of moving those products into the new world will probably be led by the definition and forcing those into a clearing model. So perhaps you're going to see the trading model remain as is. As I say, options on listed derivatives today trade on a phone round market in Europe for interest rates or for equity options because the liquidity just isn't there and the products don't trade on the screen. I think the example that I was told was that if you look at the CDS market, if you take the most liquid single name, GE, it trades on the 5-year point of the curve 15 times a day. Now that doesn't lend itself to an electronic order book driven market. So I think the challenge from what is a technology solution to this is you are going to have different instruments traded in different ways, and you're going to have the model probably driven from a clearing definition first, and then you move into an execution world.
Jim?
I'd say we definitely agree with that in terms of what would successfully trade on a CEF and what would make sense from a client perspective. It needs two things. It needs to be standardized and it needs to be liquidity. And the contracts that we see on the London Clearing House and on the CME at the moment on ICE, we kind of feel that we're reaching the limit in terms of liquidity and what makes sense in terms of price discovery. But on the other side, you've got regulators who want to make sure that everything can be cleared because that's a much safer option. Our kind of view is that it's almost, it's like we're trying to paint an aeroplane, except the aeroplane is currently flying at 30,000 feet and we don't know where the hell it's going to land. So, we have this bottom-up approach where clearinghouses decide what is clearable. They say that they understand what they can manage a default on because they can find prices for that and they can organize an auction and they can organize closeouts. And then at the same time, you've then got the regulators saying, well, we want to force upon you liquid products that you won't be able to price easily. And there's a bit of a disconnect there, and we feel that over time there will be education and the regulators will get it, and they are starting to get it, but it is something that we're concerned about.
I hear all these, nobody really knows what the rules are going to be, and you can't paint the plane till it lands. What's going to happen on day one? Is the industry going to be ready to support this? Are, these CEFs going to work? Is the clearing going to work? What's going to happen? I wonder if you guys have thought about that. Is this industry going to be ready?
We're hoping that there's going to be a common sense phased approach. So currently there is notional trading, so there is significant notional at the London Clearing House, for example, in interest rate swaps, and there's significant notional in CDS at ICE Trust and also at ICE Clear, and that's through the Fed 14 mandate that the Fed has challenged the top banks with. So there is liquidity, there is clearing, and if those products are implemented in a way that makes sense for trading for those products, then we don't think there should be an issue, but it's going to take time. It needs to be done in consultation with market participants who knows those products well. And we kind of have to fundamentally agree that listed products and OTC products are different. There isn't liquidity, as you say, on some points. And they require a different venue and a different way of pricing. And I think one thing that's got a lot of people scared is, you know, the MiFID II requirements for block trading and how that's proposing for transparency. Transparency is a wonderful thing, but it can make the market incredibly liquid. It can blow spreads out, and I think that's got a lot of the buy side concerned.
I think the buy side is split into slightly two categories. You've got the world of the prime broker, where currently AHL operating, where we're very used to being margined. Most of the systems are the same. IRS clears through SwapsWire, credit clears through IceLink, and so the changes moving to an FCM model are very small. You know, a lot of it's click of the button. We're used to all the reporting process. And I think the buy side that's got more of a problem is the real money, the guys who trade in their own name, the guys who aren't used to being margined, aren't using any of these systems, and I think they've got a much steeper ladder to climb than us.
I'd concur with that. I think in the conversations we've had with the institutional asset managers who are trading across the asset class spectrum, they've got all sorts of technology challenges. Firstly, they're not going to move to a clearing model until they're mandated, because it's going to cost them a significant amount of money because they have to place margin. But then I guess it's if liquidity fragments across the CEF, just purely the process flow challenge that they have of executing a block trade, splitting that potentially across several CEFs, splitting it potentially in CCPs, and then the process of allocating that across their legal entity structure. You know, just purely that investment in the technology to actually move to a cleared environment is very costly, and they're looking to people like ourselves to help them.
Yeah, I mean, one thing that sort of makes me wonder is the amount of open interest that would exist within a single clearing structure, which is where the real efficiencies and benefits can come in terms of cross-margining, and with this fragmentation element being introduced into the derivatives world, I think it poses a sort of a familiar argument into the world of derivatives and to the US market that perhaps we've been quite well acquainted with here in Europe when we've looked at the equities markets in terms of clearing interoperability, which has been a kind of perennial debate. So I'm wondering whether it's just sort of Groundhog Day again, but except we're talking about CEFs and OTFs and derivatives as opposed to equities and a fragmented European trading landscape.
I guess the perfect world is a single CCP that's a utility that's backed by central banks rather than a for-profit organisation that's fragmented. Then clients can access the market with the true levels of counterparty risk mitigation and an opportunity to look at their whole portfolio across asset classes. It's just, while you've got a commercially driven organisation with CCPs, you're not going to get that structure.
That would certainly be the structure we favoured. Once it's placed. One of our big issues, I suppose, is margins. You know, now, say we talk about the prime broker world, we might be trading CDX in the US and iTraxx in Europe. Our prime broker will be able to net margin us and offset positions. In this new world of ICE Trust, ICE Clear, we're going to be getting dual margined, and I don't think they're going to be able to net those margins. I think that's a long way off. Yes.
What impact will the light of day have on these marketplaces? I mean, arguably, interest rate swap markets are very tight. They're very liquid. They work very well. They, weren't the problem to begin with. But more arcane, more structured products. You start getting pre-trade transparency, post-trade transparency. What does that do to liquidity in those markets? A CDS trades 15 times a day, and that's a liquid CDS. What about the one that trades once a week or once a day even? How is that impacted with potentially pre-trade transparency? I mean, what happens to the marketplace?
My view is it doesn't work. It doesn't help the dealers. It doesn't help the buy side. There'll be wider pricing. One of the developments we've seen recently, but I guess in the more liquid markets, in the credit indices, you've seen a big move that, I suppose, RFQ-based. Bloomberg's made a big stride forward in offering all the banks this service. And in the last 2 months, we've seen 6 banks launch their RFQ-based system across Bloomberg, which is almost, for us, a perfect system. You get a whole series of prices. You don't have to go and ask everyone. You can see where the market is, and you go and trade with the one. The big restriction I don't want to do is go and have to ask 3 people. I want transparency in pricing, and then go and ask the one person to deal.
Yeah, I mean, I think the point was made earlier about the dealer community is already clearing this business. So if you look at the driver, the political driver is to get transparency, and the dealer community is clearing 95% of its credit product in a CCP. It's probably got about up to 80% now in interest rate swaps is cleared in LCH. So
Who had risk to whom? So we definitely support that there should be, joined up thinking and plumbing in terms of post-trade transparencies and trade information warehouses. This information has to be available to the regulators. However, we want to be mindful that we don't want to see multiple warehouses. In the same vein as we would specifically like one utility CCP, I think 1-2 main warehouses for post-trade data would be favourable as well.
Yeah, and I mean the bid-ask spreads will tighten, but I think there'll also be a much more sort of explicit cost profile for a lot of these instruments. Now, I think everything comes at a price and trades at a price, and that can be quite opaque and bundled into the essential cost of collateral or the margin that's set. But now you're going to see a more explicit cost structure in terms of administration, legal, clearing fees, broker fees, execution venue fees, and I think that even though there may be a higher collateral burden, I think you'll see competition in terms of those fees, and I think that you'll see more clarity and less opacity when it comes to the price profile of these instruments.
I think that's fair.
Well, you talked about optimal market structure is one CCP. Should there be fungibility of positions among all these different central counterparties that could potentially evolve? Is that a better solution, or a market utility? And we can really get into some nitty gritty here. What does it mean for the vertical clearing model that's used by a number of very large derivatives exchanges around the world? Is it best to go to an OCC type model, Options Clearing Corporation model, where it's a utility, or a DTCC type model, or should there just be portability and fungibility among clearinghouses?
I guess the other, look at OCC as a great example. It's probably one where you can see competition at the execution point. You see 7 or 8 execution points, trades electronic, and it all clears into one place. The problem around comparing perhaps equity interoperability at the clearinghouse level to the future options model is the challenge of open interest and margin management. So it's, in an ideal world, you'd have a sensibly priced utility model, so that users are, not sitting in a monopoly position that we might have with the vertical silos in the future options world, and then you can manage collateral a lot easier.